Hello, class. Week 2, we're going to go over the statement of cash flows. This is an example of the indirect method. So in this video, we'll go over the cash flow statement. So like the income statement, it's considered a change statement, right? So it's not just a point in time like the balance sheet. It has a start date and an end date. So the statement of cash flow has many purposes, but the main purpose is to provide information about cash receipts and cash disbursements. Remember that. Primary is cash receipts and cash disbursements that occurred during that period. It is helpful for creditors and investors in assessing the entity's future probability, profitability, liquidity, long-term ability to repay debt. Generally accepted accounting principles, GAAP, requires a statement of cash flow for each time there's an income statement period. So each time the company prepares an income statement, if you're a public company, you need to prepare a statement of cash flows. Overall, there are 3 sections of the statement of cash flows. First, you have operating, which are primarily driven from your core revenue. So if you're a shoe company, it's based on your shoe sales. So you have operating section, investing section, and financing section. We're going to specifically look at the operating section using the indirect method, right? So we have the direct and indirect method. We're going to use, in this example, the indirect method. So this process requires us to convert accrual accounting back to cash. So the whole basis of our accounting studies right now is to record accrual, right? Not when cash is received or paid, but when it's incurred or earned. So to do this, we need 2 balance sheets, an income statement, and the time between the balance sheet dates. So let's look at an example. Operating activities show the inflows and outflows of cash that result from the normal activities reported in the income statement. Items that we look at are non-cash items and current assets and current liabilities. Let me say that again. On the cash flow statement, we're going to make adjustments, whether it be increases or decreases to non-cash items. What's a non-cash item? A gain, loss, depreciation, amortization, depletion, and current assets and current liabilities. The first step we need to do is to adjust for non-cash items, again, such as depreciation, amortization. Then we look at changes or increases and decreases in operating assets and liabilities. We call these current assets and current liabilities. We also need to subtract gains or add back losses. For example, depreciation expense does not reduce cash, but it is subtracted to get net income in the income statement. So that gets our net income figure, although it's a non-cash item. We have to add back the depreciation expense, amortization, depletion to net income to arrive at the amount that we would have had if depreciation had not been subtracted. Remember, we want to see cash accounting in this process. So with the cash flow statement, we're doing the opposite. So we're going from accrual and we want to go back to the cash basis. Again, we're trying to reconcile our cash flow. So we have to account for gains, losses, because they've already been added in the investment section. So for example, if you sold equipment for a gain, and including just say you sold it for a gain of just say $1,000, but you sold it for $19,000. You included that $19,000 already in the investing section. So we can't double dip. We have to take that out. You have to subtract that gain in the operating section. In the indirect method, positive adjustments to net income are made for decreases in related assets, in related assets and increases in related liabilities, while negative adjustments are made for increases in those assets and decreases in those liabilities. It's a lot said. I'll show you some examples on the next page, some items to help you remember that. So it definitely can be confusing. Again, I'll show you a trick on this next slide. Excuse me. So how you read this is increase, decrease. This is current assets. Decrease, increase, cash flow. Same thing. Increase or decrease. That's one of 2 things can happen to the current assets and current liabilities. We can either increase or decrease. and its respective effect on cash flows over here. For example, if we increase from one period to the next period on the balance sheet, we show an increase in accounts receivable of 6,000. We'll have an increase here, and the first line over here will be a decrease. So we'll see more. This is more of a memorization tool. Notice that when you're dealing with an increase with assets, the corresponding effect on cash flow is always reverse. So that's why I have that in red here. So there's always an inverse relationship with the cash flow, regardless of the amount of increase or decrease. So once you remember this, excuse me, the explanations will become clearer. So we'll see in this example, oh, actually, here's some examples here. So examples of current assets: accounts receivable, inventory, prepaid expenses. Example of current liabilities: accounts payable, salaries, interest, and income taxes payable. Always add depreciation expense, gains, and always subtract losses. There's more items, and we'll learn that more in intermediate accounting. You'll have other items such as premium on bonds, discount on bonds. So, and we'll get to that in the actual net cash flow chapter. So here's an example. Accounting records of Silverwood Company provided the data below: net income, depreciation, increase in accounts receivable, decrease in inventory. See current asset, decrease in a current asset, decrease in a current liability, right? Increase in a current liability. Prepare the reconciliation of net income to net cash flows from operating activities. Again, we're just doing the first section of the cash flow. Here's my little handy dandy chart over here. So let's go through this. The first thing we do in the cash flow statement of cash flow, is name it. Silverwood Company, statement of cash flows. You'd most likely have a date here. In this example, didn't have one. So cash flow from operating activities, we start with net income, right? Because we're going to go with net income. We're going to reconcile back to cash accounting. So 17.5. Adjustments for non-cash accounts. So here's what the textbook says. You can disregard this right now. Non-cash effects, opposite direction. Add non-cash expenses, subtract non-cash revenue. So depreciation expense, it is $9,000. So anytime we see depreciation expense or accumulated depreciation has increased over time, we're going to add that back, because we're adding it back because the original net income figure, we subtracted it to get that net income figure. So we're going back to cash, so we're going to add this back. Again, accrual accounting to cash accounting. Okay, that was the first portion of the operating activities. The second portion is changes in operating assets and liabilities. Said differently, this is your changes in current assets and current liabilities. Increase in accounts receivable. Okay, let's go to my diagram here. So if we have accounts receivable is a current asset. So if we have an increase, we will have a decrease in cash flows. If this current asset decreased, we would have an increase. See the inverse relationship here? So increase in accounts receivable, we're going to have a decrease in cash flow, so we're going to subtract it. Decrease in inventory. Inventory is a current asset, and if we decrease it, the corresponding second bar is we increase it. So if we we increase the cash flow. So if we decrease the inventory, we're going to add that decrease. Decrease in prepaid insurance. It's going to be the same thing here because these are both current assets, right? So we're going to add that. So now let's move on to the current liabilities. Decrease in salaries payable. Salaries payable is a current liability. If there's a decrease, we're going to reduce the cash flow. See how these are the same direction? So if we increase current liability, or if the current liabilities have increased through that time period between those two dates, it's going to increase cash flow. If it decreases cash flow. So this will be a decrease of $2,700. Increase in interest payable. So if we're going to increase the current liability, we're going to increase the cash flow. Increase means add. And that is net cash flow from operating activities. You add all these up. Add, subtract, add, subtract, add. We get 28.3. And if we did this with the direct method, you'd get the same result. You'll get 28,300. So any questions, please post in class. And again, or I'll have this posted in class, and you just reply right underneath it. Thanks, guys.